on the debtor side, record interest just the same. But look at the last period, what happened. They pay only 80, but the amount of bond is 100. So what they get in return? Gain. Right? They got the gain. This is what they get. Okay? Now move to the creditor side. Very easy. This one easier. This one easy. Okay? this one easier, but this one easy. You know the degree now. Okay, for creditors here, what happened from this scenario? The carrying value at the end of year 1, after you discount this and interest that you're gonna get, this is the amount. At the year 2 is like this. This is what impairment loss you record like this, like allowance for bad debt. So recognize the expense. Once you get the interest, this amount is 10% of this. It's just like this amount grow up with the interest rate. Clear for that? And the difference between the interest you got, which is this, and the amount that blow up here is called interest revenue. Like this. If you add this number together, you're gonna get about 19, 18 something. 10% of 18 is gonna be this. Clear? 16 plus 1, 16.5 plus 1.6, you got 18.1. Multiply by 10%, this is what you get. It's blow up again. And the difference between the amount is blow up here and discount table, this is the interest revenue. And finally, this is what you get. They reverse allowance. They're not going to get lost because the loss already record across town. The loss already record right here already. All right. This is just for loss, not restructuring yet. Now I'm going to turn when we do that to do restructuring. Okay. Use the same example and jump into here. Same example when we want to do restructuring. Same scenario, creditor, no receivable 100. 1 year later, 2 years later, sorry, discount reduced to 9.90. Where I got this one from? You don't need to turn, I'll turn for you. This is the balance at the end of year 2. Alright, so it means what? Coupon rate subtract by discount. This is the book value of the bond or of the AR. Okay. So this is what you got at the end of year 2 from on the financial statement in terms of creditor service. And a couple minutes ago, you record allowance for about 18. So this is the book value of the loan that you give to the AOL. All right, after they record impairment loss already. Look at the other side, nothing happened to this guy. I don't care what they record. This is what I record. Right, I record just like what I did. Pretend like nothing happened to me, isn't it? But this guy prepare for the worst already. So look what the difference. The book value report at 72. The book here report at 90. Alright, so it means what? The creditor, which is the bank, think I'm gonna get money from this only 72. And this guy think I'm gonna pay to them for 90. Okay? So this scenario happened. Then what's next? What if the company, which is AOL, think I'm gonna get bankrupt or get financial distress? I'm going to talk to the creditor and say, hey, I don't think I can pay for 90, but I got the land. please take the land of my company. And after you get the land, that will be all. Alright? So in this scenario, if you are the bank, what you're gonna do? You should get the land at the market value, isn't it? Alright? Let's suppose if the land book value now is 50,000, but the market value is 60. You are AOL. You give the land to the bank. You have gain or loss from this land. First, the land price go up. You have gain or loss? Gain. Alright? The land price go to 60. What is the amount of your liabilities? The book value of liabilities. You can turn back from the last page. What is the amount of liabilities? 90 something, right? But you pay off by the land. Then you have a second gain, isn't it? So you have gain from the book to the fair. This is one gain. And another gain is what? From the fair to the value of that you want to settle. So you got two separate gains. First gain we call gains on disposals of the land. Second gain we call gain on the restructuring. So if you turn your hat into your creditors, what happened? Value of debt is about 72. Couple minutes ago, you see that slide. But you got a land at how much? 60. Right? How much is it for the loss? 12. Okay? I'm gonna prove by recording to represent 3 items here. But you need to get the big picture first. By construct the transaction like this, what's going on? Look at easier part, not easy one, easier first. Debtor. The land book value is 50. Fair value is 60. First, you need to mark up, just like you revalue the land, isn't it? You bump up the land from 50 to 60, bump up to 10. Okay, you debit land up, credit gain on dispositions. Now it's time to do swap. Credit land, debit notes payable, and recognize gain. Clear for that? Look on the creditors. Creditor got land at 60. Clear out the note receivable, clear out the discount, clear out all the allowance. The difference go to loss on TDR. Alright? Look what happened. One got a gain, one got a loss, but different amount. In fact, if you add this and this together, how much will it be? 30. Right? But this loss happened in period 2. But what happened to this amount? This amount happened in period 1 already for 18, which is 16 and 1. This means what? Look like you just recognize bit by bit on loss of TDR. Alright? This one got gain for 30. This one have lost this period only 12. What happened to the other 18? We already set up as allowance for doubtful account. So it means this loss been recognized in prior period. In year 1, in year 2. Okay? What if I say, no, I'm not going to do this deal. I don't want to swap the land, but I'm going to issue common stock instead. You take my share. Don't take my land, just take my share. Same thing happen. Copy and paste. Different is common stock and not a land is turned to be investment. Because I give you the share, you got the right to claim on my security, which is called investment in equity security. All right? Compared to last slide, this is the difference. This is the difference, which what I like. Land this side, go to land other side. Common stock this side turn to be investment in the other side. But same gain, same loss. Nothing changed. Okay? Now let's say if I have to do like mix of the term. I restructure as well, but rather than you get my land, this is the term I'm going to do. Please extend my note receivable term to year 2004 and reduce the amount that I'm going to pay from 100 to 60. All right, this is the first two conditions. I'm gonna do like this. The first condition is extend maturity from 2003 to 2004. It means you extend the period to pay for the next 1 year. And rather than pay off 100,000, I'm going to pay 60,000. All right, but I give you 12% of the new interest. All right, so by these scenarios, I recalculate the present value of the bond. Discount at 10% market rate. Coupon rate is 12%. All right, so if I do the calculation, in the next 2 years, this is what happened. You're gonna have 60 in the next 2 years, which is at the end of year 4, year 3, and year 2. This is the principal. During the year, the coupon rate turned to be 12%. This means you're gonna have 7,200 and 7,200, which is 12% of 60,000. All right, and then I discount this back to the present. Discount back to the present at the time of negotiation. And all the number together here, this is the discount at 10%, which is the market rate. Even coupon rate is 12. So the number you got 62,08264. This is the present value of 1, 2, and 3. Add all together. This is how you value the bond, isn't it? Discount the futures value, discount the futures money back to the present. All right. With this scenario, what's going on? All right. If you do the calculations, you need to do effective interest rate table. Let me show this way. It's down here. The present value is 62, right? Interest based on coupon rate is 7,200. Both. At the end of period is the amount that you're going to pay. The discount value from year 4 back to the present at term of year 4, this is what you got, 55. And for this discount back to the present, you got 6.5 here. Basically, you add these two numbers together, this is what you got. Same thing, just like what I wrote down. All right, I'm gonna use this amount, or just this amount, into the journal entry within the next slide. Okay, let's start with this one first. Nothing changed for this. 72. This 90. All right, but they restructured the term. What happened? Look on this side first. What happened? We renew the term. So the old one get rid, got the new one. What it is? It's coming from 60. I'm gonna show like this. This one is better. The old debt gone. Debit note payable 01, 100,000, and create the new debt. Got about, this is the principal, this is interest, right, for 2 periods. Finally, this is what you got. Okay, what else is gone? Discount that you should record before. Finally, difference between debit and credit, you got gain on TDR for 16,509 project this. This is the new debt. Every time when you pay off the debt, you pay interest, you debit notes payable 72, credit cash 72. Pay again, debit notes payable, credit cash 72, 72. And finally, you pay off debit notes payable, credit cash for 60. That's it. Everything gone. This is what happened on debtor side. Get rid of the old one. Record the new liabilities with the restructuring term. Because you ask them to, I want to pay principal 60,000 in the next 2 years. With 12% interest in the next 2 years. So this 12% of this is 12% of this. Got it? So the total liability that you're supposed to pay in the future is 74,400. So you restructure from the old debt to the new debt. All right? And you recognize the gain. So it's fair. Now turn to the other side. This one. Okay? Get rid of the old, record the new. But record the new with the present value, which is 62, not 74. You see that? It's different. They record at 62. Get rid of the old one. This is the pack of the old one. The par value of the note, the discount on the note, and the allowance that we used to record. The difference go to loss. Check loss and gain is not equal. Alright, because they record the new loan with the present value, but this one they record with undiscounted value. Once they got the interest from this guy, what happened? They pay cash 72. This guy got cash 72. Right? What happened? Record interest revenue and get rid of the note receivable. Because at the end, what you're gonna get the note at 60,000, isn't it? This is the new principle. So that's why you need to mark it down. Same thing happened for the second period. They pay cash, I got cash. When I got cash, I marked down this another time and record the interest revenue. Finally, when they pay at the principal, I got cash at the principal too. Alright? So by doing restructures, what's happening here? Gain recognized as the first place when you do restructuring term. The other guy recognize loss when you ask for restructuring. But it's different number. Okay? During the time of the restructuring period, what happened? On the debtor side, you pay off the notes straight away. On the creditor side, once you get the money, you need to record the interest revenue. This is the effect of the trouble debt restructuring. Alright? This chapter is quite tough if you go in detail. But I just give you like a preliminary example. This is what happened. You're going to say, Ajahn, this is just a preliminary for sure. Accounting students learn more than this. So this is just part of what we learn. Alright? You are MBA student, just get to know. Well, if somebody asks you to do restructuring, what happened? First, somebody gonna have gain, somebody gonna have loss for sure. Right? Who gonna get loss? Debtor or creditor? Creditor get loss. Debtor supposed to have gain. Right? If debtor got the loss, not gonna happen. Right? Debtor supposed to have gain. Creditor supposed to have loss. Loss record at once when you do restructuring, isn't it? Alright? And if you negotiate with like, I want to exchange the asset, you record the asset at fair. Difference between fair and the debt is going to be gain or loss up to the value of the money. Alright? That's why when I explain this one, I know it's quite hard for you guys. I'm gonna end with this. I like these pictures. Very easy to understand. If somebody asks for restructuring, this is what happened. Right? First, compare what you have and what you're gonna get. If what you have greater than what you get, think about if you are creditor, what you have which is like receivable greater than what you get. This is what you have, this is what you get. You have loss. Right? What you have liability is 10. What you get is 8. You get loss at 2. Turn to the debtor side. 10, 8. Book value here, let's say 5. What's happened? The asset report at 5, but the fair is 8, so you have gain about 3. 8 compared to 10 is mean what? I supposed to pay you at 10, but I give you the asset at 8 and you say, oh, you settle. We got gain at 2. To simplify those scenarios. That's why when they ask me to teach this topic, I say, well, to make it easy, I can speak in 5 minutes. Like this. Somebody got to have gain, somebody got to have loss. Let's go out, recognize the new one. But if you want to go in detail, it's going to be a big mess like what you see from the other slide. Because, well, you're going to have to think about term structures, interest, revenue, interest, expense, right? But the big picture is right here when you do restructuring. Okay? So today what we learned so far is, for the first part, we're talking about FX, translation, FX transaction, all right? We're talking about IP. IP got 2 models, cost model and fair value model. Recognize one thing, for cost model, you cannot revalue for IP. Why? If you revalue, it means you try to use fair value model. That's why some people ask me during the break, like, can we mark to market if we put cost model like PPE? I would say no. Because if you decide to revalue, it means you want to use fair value model. All right, keep this in mind. Okay, now turn to TDR. For TDR, it's like somebody debtor, somebody are creditors. Creditor give the loan to debtors. If they do negotiation, creditor have loss for sure. Creditor have gain. All right, from the negotiation. Otherwise, it's not going to call restructuring. Because when you're restructuring, the debtor can benefit from that. Okay, hopefully this is enough for now. For the next couple weeks, life not going to be easier. I told you. Because we're going to talk about lease, talking about deferred tax, and talking about employee benefit. Be prepared for that.
Okay.
That's tough if you want to teach in detail, but if you want to make it simple, I can say very simple, just 5 minutes as well. But you can get nothing. All right? So, the other one that we're going to learn, we're going to talk about equity part, which is treasury stock, earning per share, blah, blah, blah. All right? Okay? About the presentations, somebody asked me like, about the company that going to use, do we have to have the firm that been announced like they have earning manipulation? I'm going to say yes and or no, up to you guys. There's like some group want to compare with industry peer and think it can be manipulated. You can do as well. The question will be next is, what if I find nothing? If you say, if I find nothing, it means the way you motivate people is nothing as well. Right? If some people are like, why you pick this company, it means nothing to me. Of course, it's going to end with nothing. Isn't it? Let's suppose I want to compare SCG with SCC. Alright, Siam Cement Group and Siam City Cement, for example, same industry. But what motivates you to think they're gonna do earning manipulation? What caused them? Let's say Siam City Cement now they bought a lot of companies, they do a lot of mergers. Why they do that? On the other hand, SCG didn't do that much. Why they didn't do that? Is that enough to bring that as an issue? This is one kind of thing. You can do financial analysis, go back history whatsoever, fine. Another case can be, well, I'm going to go for picnic company because SEC announced they do earning manipulation because they reverse the revenue. The news is there. How you going to present to be interesting? All right. So there are pro and con between these two groups. One group, no news. I suspect to be something. You got to motivate people why it's got to be that thing. The other group, the news is there. I know they manipulate, but how to make it more interesting? You can compare. Well, I think we can compare with the other case, for example. I'll let you choose. So it's free fall of everything. All right, but at least you need to engage earning manipulation issue and financial statement analysis in there. All right, any questions? Good. All right, so now class dismissed. I'll see you next week. สวัสดีครับ